Hello. Thank you for joining me for this edition of Fed Watch. Today is March 8th, 2024. And earlier this week, Fed Chairman Powell was testifying on the Hill, both to the House and to the Senate, about all things relating to the Fed. And some of the bottom lines that came out of that were encouraging, actually. He committed to lowering interest rates in 2024, although he didn't say exactly when. And committed had a qualifier. He said they're still not sure that they're going to get to their desired inflation rate of 2%. And I think given how badly they missed some of the early signals, they're going to want to be very sure before they alter course. I think that still puts us online for May, maybe June, first step down on interest rates. The more encouraging part of it, from my perspective, was the Fed sounds like they're very closely watching particular banks that have large uninsured deposits and are exposed to the commercial real estate market. Remains to be seen how far ahead of that problem they can get and what their resolution is going to be. But at least they're there, they're watching, and it shouldn't become a systemic problem. And that's been one of the things that's been keeping me up at night. So to know that they are watching at least and they're recognizing it in front of the body politic, I think is really good. Just so you know, though, Powell did say expect to see some bank failures. They're just going to be the smaller banks, but they fully expect to see some failures arise out of this. It's just how they're going to contain that from spreading is the bigger issue. You're going to be safer having your money in larger banks, be they regional or some of the very large banks. Small banks are going to have more risk associated with them. Something else I wanted to talk about, and this data just came out this morning, is the employment data. And we're still looking at phase C in terms of employment. In other words, it's still growing, but at a very slightly decelerating pace. We look at ITR, we look at employment only in the private sector, non-farm employment, and that's growing at a 1.6% clip. And again, it's just slowly easing downward from there. The numbers that you may have seen in the news on Friday, that includes government and military. So that number is a little bit different. That was 1.8%, but the trend is very much the same at phase C. Going back to the data that we prefer, it's not seasonally adjusted. So when I looked at the January to Feb change in employment, that growth, it was actually a little bit better than normal, which is a good sign that the economy is at large going to continue to grow here, at least through the first half of 2024 by my reckoning. And that's primarily for GDP in the service sector, certainly not so much for the industrial sector. Which brings me to another point. The updated new orders data continue to show cracks when it comes to manufacturing. We saw consumer non-durable good new orders slip further below year-ago levels. Overall manufacturing new orders slipped to about a minus 1.6%, 112 rate of change. So that means the data trend has now turned down. Mining is running below year-ago levels, effective with January. That was down 1.3%. So we're not seeing big numbers, huge numbers, but we are seeing where the industrial side is showing some cracks, and it is going to clearly be in a different trend than the service sector. I wrote a whole executive summary about that in this month's trends report that'll be coming out in a few days. You can read more about that then. It's just a tale of two trends right now within one economy is what we're looking at. And that's probably good news from the Fed standpoint. They're seeing some weakening without unemployment going high up, although unemployment edged up to 4.2%. So that's quite a change from where we were in April. In April of this 23, rather, we were at 3.1%. So the Fed must be pleased that at least unemployment is edging upward and probably relieved that it's not skyrocketing upward. Mortgage rates on the 30-year fixed rate mortgage, they're in the high sixes. Sometimes you see low sevens. But the improvement that we've seen so far in the mortgage rates, improvement being the modest decline, seems to have been enough. There was good data this week about first-time home buyers being intrigued by the slight dip in interest rates. And there's some nice positive activity in that side of the market. It's refreshing to see that they're finding a way to look past these high interest rates as the marketplace normalizes. Look for that housing to continue to be a nice green shoot for the economy as we head into 2025, but also a mitigating factor on just how much the Federal Reserve is going to be lowering interest rates in 2024 and early 2025. So all things seem to be on track. If you benefit from lower interest rates, they're coming. It's just not going to be a big move. We're continuing to think for interest rates in general, we're looking at maybe 100, 150 bips on the downside. So nothing to get us back into what people used to think was normal territory, which was really la-la land, but enough to take some of the pressure off the economy. That's the way we see it today on March 8th. Thank you for joining me for this edition of FedWatch.